Oh, 7.
All right. We are live. We are back with This Week in Crowdfunding on Next Big Thing HQ with our most highly anticipated episode of This Week in Crowdfunding yet. Today we are joined by... Oh, wow. I had it going on in the background. Technical difficulties. I apologize. We are joined by Yvan De Munck and Woody Neiss from CClear, the leading crowdfunding data company in the industry. An incredibly exciting and an incredible honor to have them on to talk about their monthly crowdfunding report, which is a completely inclusive and full-fledged data report on everything equity crowdfunding, perfect for the equity crowdfunding investor and crucial for understanding the industry, the market, and trends. So, Yvan, Woody, why don't you guys introduce yourselves and tell everybody a little more detail what CClear is doing. And again, thank you guys for coming on This Week in Crowdfunding.
Woody, go ahead.
First round or?
No, you go ahead, Woody.
Okay. All right. So, guys, it's great to be here. It's great to be here with everyone that's watching as well. My name is Woody Neiss. I am one of the guys that went to Washington, D.C. with an 8-bullet-point framework called the Startup Exemption at the time to allow startups and small businesses to raise capital online. I was living in Washington, D.C., so it made it quite easy to go down to the Hill, talked about the SEC, people in Congress. There were 3 of us that did the lobbying in the House and the Senate. Our bill, of course, turned into investment crowdfunding, regulation crowdfunding. We were at the White House for that. Wrote the Dummies Guide to Investment Crowdfunding, and then built this database that collects information on all the companies that are raising capital online. So have a good inclusive view of what's happening in the industry, from someone that wrote the law, from someone that's helped companies raise millions of dollars by the law. I actually have a background in startups. I've raised millions of dollars through my own venture-backed companies. So I can see sort of this 360 view on it. And at CClear and our other parent organization, CCA, Crowdfund Capital Advisors, we sort of sit at the intersection of 3 parts of this industry. The data, which allows us to see everything that's going on in the industry. Venture, which is a venture fund that we've launched to invest within the industry that's all AI based, and it looks at what we believe are the best deals coming out of the space. And then liquidity, which is a part of the equation that a lot of people don't focus on, which is how do we get out of these investments that we're in. So today we're going to focus right on the data side because I think that's the fascinating stuff. And with that, I'll turn it over to my partner, Yvan.
Thanks, Woody, and hi, everyone. Very excited to be on here as well. So as Woody indicated, I joined the team here about, 3 months ago now. Really, my past is first 10 years on Wall Street. I ran a broker-dealer selling European equities to U.S. institutions for a European bank. And after that, I wanted to do something else. And I was, falling into the fintech kind of story that was started in 2010, 2011, really around consumer lending, the whole development with P2P lending, online lending. By the way, at the same time that the whole crowdfunding kind of story started back in 2012. And that's how I, started following the team at CCA as well. And that's where I know Woody from and his team. But for the last 10 years, really involved very closely with fintech startups. So very early stage, helping to build businesses, primarily around consumer lending. But I'm very big in startup businesses, small businesses, and so I've been an investor myself, angel investor, and I'm very excited now to be able to participate in this story. So my role is really helping to build and grow the business around CClear in particular. So it's really sort of commercializing that data set that we have that I think is extremely valuable for anybody who's active in the space, both on the issuer side and also on the investment side. And so I'm very excited to be able to announce that we have now a number of products online that are available on the website. We also have a page specifically on gumroad.com where we have periodicals. So we have a bi-weekly report, we have a monthly report, we also have an annual report that really sort of details everything that's happening in the space, Reg CF, with 100% data coverage. Compare that to a couple of other players, I think we're pretty unique in that respect. So, looking forward to talk about it. People can check it out and subscribe to it. We have a couple of, free products as well. But yeah, thanks for having us on the call. And, looking forward to talk about November, what happened in the space.
Well, that sounds great. Let's get into it.
All right,
Yeah.
Woody?
Presentation, Woody and Yvan provided us with a PowerPoint, and they're going to go through the November data. Once I pull this up, you guys let me know when you can see it.
We can see it.
See it? You can bounce on over to the next slide, and I'm going to sort of give you guys a conversation about this. So the capital markets really do not operate independently of what's happening either domestically or globally. And so when you look at what's happening in the markets, you have to take into account what are the factors that are driving what's happening. So there's this whole backdrop of economic data that's happening, with our economy, geopolitical events, and some of the things that were happening in November, where the Fed had their second meeting where they held the interest rates at the same time. They did that because we see stabilization in the core inflation rate, but those high interest rates mean investors really can put their money into money market funds or elsewhere and earn these yields that are very attractive. So they have to decide, do I want to put my money in a money market fund, or do I want to risk some of the capital and put it into these, equity crowdfunding offerings or public markets in general? Our economy is really strong despite, strikes that we've seen. We have seen job growth slowing, wages continue to rise, which is also a point of concern for, the Fed, if that leads to higher inflation. But we've also seen unemployment claims hit their highest level since 2021. So the Fed looks at that as oddly enough, a positive signal, that the economy is slowing. And then, of course, we've got these horrible things happening globally on a geopolitical stage, where we've got the war in Gaza, in Ukraine. We've got these unstable oil prices as a factor of that. And so that all plays into what's happening with issuers. Like, is this the right time for me to go out and raise money? Or investors saying, is this the right place for me to raise money? And so all of this sort of plays together into what's happening on a daily, weekly, monthly, and annual basis within the industry. So if you can jump to the next slide, we can sort of talk about, start digging into some of this data. November was a fairly strong month for investment crowdfunding from an issuer's perspective. So these are the companies that are going out saying, I want to raise capital. It was 136 new deals in November, which is up from October, which was only 115, and down from 143 last year. I want to say that the average for the past 12 trailing months was about 125 or so. So it is higher than that. And what that means is, even though it's down from last year, these issuers are thinking, is this the right time for me to go out and raise capital? So there's concern on their part if the market timing's right, if the investors will show up. And so we've seen that pullback. And that's has happened all through 2023. 2022 is the highest year, I want to say, for these issuers out there, at a time when we saw supply chain issues, we saw the interest rates soaring, and we saw hyperinflation happening. So year to date, there's been 1,327 new deals. Like I said, that's down from last year at 1,473. So all in all, that means issuers are questioning what's going to happen. I do think going into next year, and we'll probably talk about this towards the end, that'll be changing. But if you're just looking at that chart right below, you can see that it's been up and down, and we've been in sort of this downward trend that we've seen for the past year and a half or 2 years from the spike that we saw in 2022. Now, I think that's all going to change. I think as issuers become more confident in the marketplace, that's going to lead to more people online. Of course, as VCs are still holding on to their cash or funding their own companies, this just means that alternatives, and that's where investment crowdfunding plays an important role. So I believe as the trend line shows that number is going up, we will see that number go up over the next year. If you look at geography, so where are these offerings happening? When you look at the number of deals, you see California, New York, Florida, they've got the highest population. So it's not surprising that per capita, they've got more offerings in other states. But when you dig into the data, and that's what's amazing about, when you have your hands on the entire data set, you can actually see what's happening. And so we're seeing stories like Philadelphia, Denver, Sheridan, Wyoming, and Kansas City having more offerings than they have on a year-to-date basis than last year. So things are percolating there, which I think is a really positive sign. I'm based in Denver, Colorado, and I love seeing all these new offerings coming out. As a matter of fact, we tend to jump in the car and head to one of these restaurants or one of these places that's raising money just to check it out and be like, hey, I saw that I saw you online. I think that's a cool story, and it sort of builds that whole community around, why people are engaged in crowdfunding. But on the other hand, we're also seeing a drop off. So New York City, San Francisco, LA, they've seen about a 30% drop in deals. Again, I think all of this sort of plays back and forth. The big cities will always have the most offerings, but I think what we're seeing is this distribution of offerings across the country, which means that more opportunities. Our job, the industry's job, the media's job is to let people know that, if you need access to capital, banks aren't lending right now, that's for sure. So debt crowdfunding is an opportunity. But, equity crowdfunding is there, where VCs might actually be saying to a lot of these companies right now, you probably should look into equity crowdfunding, see how much you can raise, and then come back to me for a round. And maybe that is what we're seeing in places like Denver and Philadelphia right now.
So Woody, if I can interrupt here, I think this is exactly one of the most exciting parts of this whole industry, right? The fact that, in flyover country, now suddenly you see quite a bit of activity, and everybody knows instinctively that there is a lot of activity going out there, but in the past they weren't able to access capital because everybody always says it only happens in New York and it only happens in LA, or it's only happens on the coast, right? And if you're in the middle, you're nowhere. You can't. It's really difficult. So now you have here proof actually that quite a bit of excitement is in this middle America, where plain vanilla businesses who just need capital to grow solid business can finally access capital through this, through this way of raising funds. So I think that's one of these elements, and there are some other ones, but I think that's one of the highlights here. Very exciting development that I think is only gonna accelerate from here.
And I think that's a
Woody.
really
Can I add something to that?
Yeah.
I have a question for you. So we're seeing a spike in cities like these smaller cities as we're talking about, and I don't want to bury the lead if it's later in the presentation, but are we seeing mostly equity deals, or is this a lot of debt deals as well? Because a theory of mine would be that a lot of these small cities, it's not necessarily just big time high growth startups, but it's also small businesses as well utilizing it.
I think that's a phenomenal point. When the industry got started, we thought the opportunity would be tech companies and maybe retail cash flowing businesses, Main Street type of things. But we didn't see a lot of the debt crowdfunding offerings that we thought we would see initially. Now, if you look at November, and we'll talk about this in a second as well, the number one platform for November in terms of new offerings was Honeycomb. Okay, so they're a debt crowdfunding platform. So it goes to show you that there's this shift that's taking place right now. And I think it's a fascinating story, though, because clearly what this means is these small businesses can't get financing from a bank. Banks just aren't lending to them right now. So that's broken. So they're coming online and they're raising money from investors on these platforms at yields that are insanely attractive. You can get 5% in a money market fund, but for 36 months on a Honeycomb deal, the average interest rates is about 1%, I think, right now. I'll take that. So I think the whole debt crowdfunding opportunity is one that's scaling over time, and we're seeing a higher percent of these offerings on a monthly basis be debt offerings. So there's only, unlike the equity crowdfunding platforms, and mind you, since the industry started, I think over 150 platforms have registered with the SEC and FINRA. Many have gone out of business, but there's about 80 active ones right now. There's only like a handful that are debt focused. So the opportunity there, I think, is great. But the people that are in that space, SMBX, Honeycomb, Mainvest, have really built a name for themselves in that space.
So Woody, if I need to pitch in here. You talked about Honeycomb, just pointing people to, if you link up with me on LinkedIn and you sign up for my, newsletter that I post like every couple of weeks. A couple of weeks ago, we did a deep dive on Honeycomb with an interview with the CEO and Woody writing very detailed about the platform. So feel free to go there and check that out. But yeah, it's one of these exciting platforms that is doing extremely well on the debt side. Back to you.
Okay. So the other thing I think that's truly fascinating about this industry is the industries that are raising money. Because when you think about who's going to go out and raise money, if you're some biotech company that's come up with a CRISPR technology that's going to change the way, drug treatments happen, you got to be thinking, well, my investors need to be pretty sophisticated, understand the technology and what we're doing. And what we're finding is yeah, that's true. But the reality of why this works is the investor base that is looking at these deals consists of many people that have that knowledge in their head. They're scientists as well, and they're investing in these deals. They just don't happen to be in the backyard of these issuers. So the beauty about this is any company that has an engaged audience can actually raise money from them. And I think that's a great thing that we're seeing. And I think there's been over 450 different industries we captured the NAICS code for them that have been represented in our data set. So that speaks to just the wide appetite from issuers that are out raising capital and investors that are interested in investing in these deals. We've seen a jump in clean tech, health tech, entertainment, restaurants, but at the same time, just, like New York and California or San Francisco are known for like software and finance. We're also seeing a drop in those offerings as well. Again, this is going to go up and down over time, but it's just great to see the broad spectrum that's represented in the entire data set. I'm trying to think if there's anything else about the industry thing that I love. We have a story about one of the offerings that took place where it was we highlight Sengen Pharmaceuticals in our October monthly newsletter. And I was talking to the CEO in the interview, and the thing that I loved about, he had so many great things to say about crowdfunding, which I love to hear. But one of the things that he said is I had an investor on one of our calls, and he had committed $10,000 initially. And then after the call, he had a ton of questions during the call, and we answered all his questions. And then he put $25,000 in, and then he upped it to $100,000. So it goes to show you that you can use these platforms for outreach. He did not know this investor beforehand, got them engaged, and by having this communication channel with them and doing things like these interviews, you can actually engage them further for higher check amounts. And I think that's a great part of it. Again, they're a pharmaceutical company, so it goes to show you that anyone can use this. And pharmaceutical companies, they have clinical trials. Think about the 7-digit figures it costs to run a clinical trial. Now, of course, with a $5 million cap, you're not going to be able to run a ton of trials, but you can really get the first part of what you need done. In many cases, with many of these small businesses that are startups at the early stages with a smaller amount of capital. And the whole point of this is we're not trying to displace venture capital or hedge funds. This is an on-road. So, you get into the funding mechanism through, crowdfunding. Maybe that leads you to angel investors. Hopefully that leads you to VCs and on and on and on. But this helps you get started, and it proves that you've got this massive engaged audience that is willing to put their money where their mouth is and fund you.
Yeah, I think that's a good point. I think the beauty in crowdfunding is that, one, as an investor, you get to talk to these founders one-on-one. And it's really hard to be in that position if you're trying to invest in these really big, tech startups that are really hard to talk to because they have a ton of venture capitalists trying to talk to them. So that's really hard for the everyday investor. But then also, too, from the founder's perspective, it's a good way to turn your consumers into investors into advocates. And we notice that time over time, Brendan and I, we keep talking about this. These companies, they will raise around, and then all the consumers that first buying their products then see they're raising around, then they want to invest. Now they're investors in the company. They feel the ownership that they have. So now they love the company, and all they want to do is tell their friends, tell their family that this is my favorite company. I'm not only a consumer, but I'm also an investor, and I love it. And that just continues to grow their reach and grows their audience.
Yeah, not only that, it's the flywheel effect, right? It's also when people
Yes.
start investing and they're happy with the experience, what we've seen also in the data is that more and more of these companies come for follow-on rounds and do another round and do another round. And that proportion is increasingly getting bigger, right, Woody? So it's something we're gonna talk about it later. But yeah, it's part of the excitement here.
Yeah, I think that's a cool part of what happens in these, and it's a data point that's right up there. In November, 16% of the deals were follow-on rounds. So that means a company that did their first round online has come back to do another round. You would be shocked to know that within the data set, we've got companies that have done 7 or 8 rounds online. Why? Because they love the experience. They're in control of the process of raising capital. I mean, listen, I've raised venture capital, so I know what it takes. It takes 12 months, a lot of talking, a lot of no's. You get a bunch of term sheets if you're lucky, and then you have to decide if those terms are right for you. In crowdfunding, you actually control the whole process. It's all set at the beginning. You decide your valuation when you go out. You need to have the right valuation. I can't, tell you how important that is, because if you hit the wrong valuation, and with our venture fund, we actually look at deals, and their valuation is one of the key figures that we look at. We looked at a deal where they had $113 million valuation on $1 million in revenue. Now, $1 million in revenue is really a great to get to, but how you come up with $113 million valuation to that $1 million in revenue is completely out of line. So you need to do your research to make sure that you have that. But just to jump back to the rounds of financing, this works well for companies that come in when they have the investors and they see, Connor, like you were saying, how engaged they are. They want to go back to those investors and raise more from them and use that just talking about to get more investors engaged. And these investors are people that look like the people that are running these companies. And I think that's an important point for this 45.2% of deals had a woman or minority founder. So, when we were sitting at the White House for the bill signing ceremony, President Obama gave a speech about, what this meant. And he's like, this will democratize access to capital. And I was just like, wow, that's a really great way to talk about it. Because, at the time, I wasn't thinking how this would impact women and minority founders. I only heard from, Silicon Valley, from people that were women and minority founders. I just don't qualify for VC funding. Well, you don't have to worry about that anymore with crowdfunding. Mm-hmm. You can go out and raise money on these platforms because the people that are going to be investing in you are probably ones that look like you. So there are many women and minority founders out there that are raising money from women and minority investors. And I think that's just another powerful story that comes out of this. So if only 2% of the money in Silicon Valley is going to women and minorities, and we can fund 45% of them, in crowdfunding, if we can get $1 billion in, we can have more impact than Silicon Valley has on women and minorities. So I think that's just, a brilliant part of this whole story. And I do want to make pauses in there just in case you guys want to jump in. The other thing that's been fascinating about this, so when we wrote the framework for this, we did a sort of a roundtable in San Francisco. The two other friends of mine that I created the framework with were all VC funded entrepreneurs. So we just went to our VC friends and we did a roundtable and we said, at what point will we be stepping on your shoes? So where should we keep the cap? And they're like, if you do $1 million cap, we don't care. But if you do 5 million, then you're going to be stepping on, our toes, and we're not going to like that. And that's where the $1 million cap came from for when we launched investment crowdfunding. I have lots of stories related to how the entire bill came to be. From. So we knew at the time that there wasn't going to be much VC participation because this was below their radar of where they're focused. Now, there are early stage venture funds out there, but they're not that many. What we've seen now that the cap has moved to $5 million, now that VCs have pulled back on their funding for other startups out there, is more syndication of deals by VCs in the marketplace. And we think that's great because it shows that this whole story that VCs won't invest in a cap table that has the crowdfunding investors on it doesn't hold water anymore. And so you've got these VCs coming in, funding these deals. 10% of the deals in November had VC participation. What that means for retail investors is someone else other than them has put their money where their mouth is, and someone that really has a degree in investing, someone that's really doing not the type of diligence that happens on these crowdfunding platforms, which is it can be the same level of diligence that a VC does, but investing in an entrepreneur that they believe's got a great idea, someone that they know, they see the revenues going up, they're in their local community and they're watching the business grow. And they want to put some money into that. But when you see a VC has come in, they've done diligence on this company that looks at the founders, the total addressable market. They've already studied, is there going to be an exit for me? That's why they put their money in the first place. So the fact that we're seeing more of these VCs coming into the marketplace and syndicate these deals brings a ton of credibility to crowdfunding in general. Okay, I think this next 104 days is the average length, down from 120 in October. So, when a company goes out, again, I was talking to you about the control that you have as an issuer in the marketplace. You set a date at which you're going to, file with the SEC to raise this capital, and then according to the law, you have to have a deadline under which you raise the capital. If you're doing a Reg D offering, like I did when I was raising money for my company, Flavor X, we just, we didn't even file that form, I think, until we were done with our round of financing. So that can be really long, but these offerings are much shorter in length, which is great because you get your hands on that capital to deploy and start putting to use much faster. And so what we're seeing is the average length of these days dropping. So what does that mean? Well, remember I was telling you about the issuer sentiment, and they're wondering whether the timing of the market is right. What I'm thinking is happening here is when you've got high inflation, when you've got these wars that are going on, maybe these issuers are thinking, the faster I get my hands on this money and deploy it to help grow my business, the better. So I'll have a shorter deadline than what we saw in October and probably what we saw last year at this time. And so you see a lot of that in the data itself. One of the things I tell entrepreneurs that are out raising capital all the time is it's going to take you, a good 90 days to put this offering together, but you should expect at least no less than 90 days to raise this money. But 90 to 140 days is where we're seeing the typical thing. So, budget like 6 months to put one of these offerings together. I think that this next point, 57% of issuers are post-revenue, is another fascinating data point in the entire data set. When the industry got started, only 35% of companies that were out raising money were post-revenue. So what does that mean? They're probably risky. Once you make your first dollar, you've proven that there's someone that wants your product. Okay, so that's a data point that everybody looks for. So the fact that we've got 50% of these issuers that are post-revenue prove sophisticated companies are coming into the marketplace. They're more established in terms of how old they are. They've got these teams, and I think I've heard you guys talk about this in your prior podcasts, that the quality of the deal flow is really changing over time. And I think that data point, that 57% speaks to that, because it shows you that there's different types of companies coming in. And that inflection really started happening when the SEC moved the limit from 1 million to 5 million. So I think we're only going to see more established, more revenue producing companies come into the marketplace, which is great for investors because they're going to be harder to go out of business. There's something, when I was running my company before, one of the data points I learned is if you can make it to 5 years in business, it's virtually impossible to put you out of business statistically. So if we see a lot of these issues, and I think the average age last year was about 4.7. If we can see that move over to 5, I think that's a data point that proves that, we're going to have failures. We will have failures in the space, but that failure percentage rate is going to drop dramatically. And I think that 57% speaks to that. Since the industry got started, there's been 7,800 offerings to date. I think there's been about 6,800 companies related to that. So, we're still small, but this is a very unique group of companies. I love to say that, your next Google, Facebook, are all in this data set. Everything that's happening in AI right now, all companies are in equity crowdfunding, doing their offerings online and raising money from their friends and family and followers, and building awareness of what they're doing through that. And I think we're going to see, a lot of great stories come out of that, be it the metaverse or, biotech even.
So Woody, maybe to play conspiracy theorist here for a second, I think the thing that crowdfunding that will really propel crowdfunding forward, and you can disagree if you want, is a big win. Like a big, you talked about maybe not a Google or, but something that, sounds like it should be a venture capital backed company, but it's crowdfunding backed and it just takes off. How far away from that do you think we are?
Well, there's been some exits. One of the things that we cover in our annual report each year is the exits that have happened within the industry. Most of them to date have been acquisitions, but there's been a couple IPOs, and they haven't performed well since their IPO, but that did lead to an exit. But I think one of the biggest stories is a company. These prefab sort of casitas and small scale homes almost. They started their online funding journey through crowdfunding. I think it was a $42 million valuation for the first round. They graduated out of equity crowdfunding, of course, because they're producing millions of dollars in revenue. But their latest valuation, I think, was $3.4 billion. So that type of company, if they decide to go public, or if they allow for liquidity from that, it's going to create a lot of millionaires. If you put $25,000 into Boxable at that $42 million valuation, it'd be well worth over $2 million today.
Wow.
Yep.
So, Brandon, to your point,
it's almost 100x. Yeah.
Yeah, that's the type of when people are running around going, "I'm a millionaire," because of what the small investment they made in crowdfunding. That's when we're going to see the Today Show cover it, and that's when we're going to get more eyes and awareness on it. And that's really what the industry is missing. We can all sit here and talk about how innovative and unique and cool this opportunity is, but until Main Street, media starts getting involved and covering this seriously, we're not going to have the really institutional capital or the growth that this industry needs.
Can't agree more. That's I've heard a little bit about Boxable, and I didn't know they were valued that high, but that's super exciting to know that companies taking off like that. They've done a lot. They did a lot of equity crowdfunding early in the company's life, so that's awesome.
And then
I
Woody,
think the latest has it that they're looking for a $5 billion valuation in their current round or something like this. So, to be checked.
Woody, I do have a question on the decreasing days, the average day length for these issuers. What are the implications behind that? Like, what do you think? Does this mean that and maybe you're going to get to this later on, but does this mean that they're raising less money per round, or does this mean that they're raising at a faster rate? Because I kind of associate the day's average length with velocity.
Mm-hmm. Yeah, that's a really good point. I think when you look at the data, so we collect investor sentiment data through the commitments that take place on a daily basis into these offerings. So every day you've got investors that are committing capital. So you've got the number of those investors and you've got the total amount of capital that's being committed. And if you look at that on a percentage basis, 1% is the first day and 100% would be the last day of the offering. You can track the flow of capital through that percentages into these offerings. What we've seen in general, the data is offerings kick off on a peak. And they raise a bunch of money when they launch. Then it sort of goes down. And depending on the news that you have coming out, you can have little peaks that come up, but the traction really picks up at the very end. And there's a reason why that happens as well too, is when you start your campaign by going out and telling people, I'm launching, I'm raising money, this is what I'm doing, and you get those people closest to you committing capital, which is why you have that spike. At the end, you've got this sort of rush to be part of this, because all these people have now seen what you've been able to do with these other people in terms of raising capital. And so it helps bring more people in to allow you to close at a higher amount. I don't think the shorter days is going to lead to any irrational behavior in the marketplace. Okay. If anything, I think it's good for these issuers that they can get their hands on the capital. These offerings do go stale. I've seen some of these just be open for a year. I'm like, I have no idea why. Nobody's looking at it anymore. It's sort of pointless. There's a lot of excitement if you're engaged in this industry to see what's going on. It's not in anyone's interest to keep these offerings open for a very long time.
Thank you.
Yeah, maybe also mentioning that liquidity attracts liquidity, right? And people want to quickly see what's really hot. So one of the things that is cool in some of our reports is that we, every 2 weeks we list the 10 most active deals in the space across all the platforms. So if you have an interest and you don't want to do all the work yourself and check out 50 different platforms, what's going on, you just go to that list. That's what I do. And every 2 weeks I check, okay, what's going on? And you go to the hottest deals going on, right? And you see, okay, and what industry? And it says, okay, these are 3 things where everybody's going to. I just go to these 3 deals, and that's where I'm going to focus on. So it cuts an enormous amount of work. But yeah, liquidity attracts liquidity, right? People see what's going on, and then they say, hey, why are other people looking at this and investing in this? And then you go there, right? It's like in a restaurant. I always give the same example. 2 restaurants next to each other, right? One is empty and one is full. Where are you going to go? The one that's full.
The full one.
Well, there's something wrong there, right? It's stupid because the other one may be excellent. I would take the empty one. I'm a little bit contrarian there. But anyway, just wanted to throw that in there.
Yeah, I think that's a great point. I think right now there's almost 590 active offerings. So there's just no way you're going to sit there and go through all of those. First, you have to find them. Of course, you can come to us and we can show you what all those are. But, to that point, to what Yvan's talking about is you have to have some sort of degree of diligence of your own when you're looking at these offerings. So you need to look at that can help you get to the offering or the investment that you want to make faster. Okay, so if we look at commitments that have taken place, November was another top 10 month. There was $55.3 million in committed capital, which was up a little from October, which was 53.5. So October was another great month. And when you compare it to last year, it was 37.7 million. So more capital is coming in, more risk capital is coming in, more interest in writing checks is coming in. And you're seeing that in the chart down below, which sort of shows you on a quarterly basis investments or commitments that have been made to these companies over time. 2021 was like a peak year for what happened. That was, when we were deep in the pandemic and everyone was sitting at home. It was a great year for investment crowdfunding with hyperinflation and everything that we saw happening in 2022. We saw, capital pull back. But we're seeing, this change now in 2023. In Q4, we still have another month to go in there. I think Q4 is going to look a lot like Q3. in terms of the total capital that's been committed. So I think that's is great. If you look at year to date right now, there's been 500 and almost $15 million that has been committed compared to 477 million last year at this time. So again, that means more money is flowing in to these offerings and investors are taking greater risks. I like to look at the deals that are raising the most money because something's happening. Like, I like to look at the deals that are raising the most money and the deals that have the most number of investors, because most number of investors implies something viral is going on here. Their community knows something about this entrepreneur, something about this company, which makes them want to invest in it. In some cases, in the thousands. And I'm very focused on who they are and what's going on with them. And I've been making investments in these companies, for years now. So that's another area where I focus. But I like to look at the companies that are hitting this $1 million mark, because that's just not an easy thing to do. It takes a lot of work. You have to have a solid company with a solid team. You most likely need revenues to prove that you're on target. And in November, there were 14 issuers that closed over that $1 million mark. So I thought that was impressive within the data set itself. And if you look at what's happening year to date, just in deals that have closed in regulation crowdfunding, not including Reg A, we do include some of that information in our data set. It's about $2.1 billion that's been invested to date. Okay, next we're going to talk about investors. So investors and their checks written. There were 23,700 checks were written in November. That was down from about 34,000 in October, but up dramatically from 13.8 thousand last year. The chart that you're seeing on the bottom shows you this trajectory of investors sort of dropping. Oh, and what's interesting? I don't think you can see.
Yeah, you're missing the background there, Woody, so it doesn't render the peaks and valleys, which is kind of unfortunate. So I'm not sure what's happening there.
Yeah, there's two parts of this chart. If the other part were there, you would see the peaks and valleys going on, and that was the trend line that's there. But so essentially, I can talk to the trend line. We've seen investors, the number of investors in these deals sort of pull back, okay? But that's okay, because if you compare this trend line to that last chart that we were looking at, where the dollar amounts were going up, what does that imply? It implies that these fewer investors are writing bigger checks. And that's actually proven through the average check, which is almost $2,400 in November, which is the third highest on record. And this has been a trend for all of 2023. So investors are looking at this from the lens of, this is an opportunity and I'm not going to miss it. And I'm willing to risk more capital in this marketplace at this time. I think the pullback that we've probably seen is probably in more of your retail investors, or we've seen more retail investors write smaller checks versus their accredited counterparts that can write and deploy more capital. So you can move on to the next slide. Like I said, we've had 150 platforms registered. In November, there were 33 platforms that facilitated offerings. We already talked about Honeycomb being the platform of the month with 40 offerings, followed by WeFunder. WeFunder, did lead in terms of the commitments at $20.2 million. So, nearly more than a third of all the capital that came in that month went to WeFunder. I think that speaks volume. Honeycomb, I want to say it was just a few $1 million that went into these debt offerings. So there's many of them. They just raised a lot less. The really, really important thing that people need to know is what are these companies doing for value creation and what are they doing for our economy? And that's what these next two areas talk about. So when you look at these companies that have done a round of financing online, and remember we were talking about the companies that have stayed in here and done a follow-on round. Well, we track everything. We track every round. We track the valuations through rounds. We track the annual reports so we can see the revenues changing over time, the valuations changing over time. When we look at the valuations of these companies that have had two invested in them, their valuations now stand at about $65.8 billion. Okay, so Brendan, to your point, $65.8 billion of unrealized value is tapped up in this marketplace right now. As soon as that liquidity starts happening, that will be the media story that captures the attention. And I'm really excited for that part of it too. The other side of it is, what are these companies doing? Well, they're creating jobs, okay? Which is an important thing, because I think the number one thing that happens when these companies raise capital is they hire people. So this is a jobs engine, and that's what President Obama was talking about too at the White House when this is part of the Jobs Act. This really is a jobs engine, and in November about 7,400 jobs were supported or created by companies that raised capital through raised investments through crowdfunding. Since the industry launched, it's about 440,000 jobs have been created. But again, so if it's not jobs, it's cost of goods sold, it's paying rent, it's everything that goes into supporting a company. And remember, we were talking about these companies not being in Silicon Valley or New York City, but to Yvonne's point, spread all across the country. Every time they spend money, it's very likely that they are using a local service provider or contractor, or buying products or goods locally as well. And the critical part about that is that money that they're spending is going back into these local communities. So it's an economic engine for local communities all across the United States. So when I talk to, city and government officials, I'm like, you really should be focused on investment crowdfunding, because the companies that raise this money are just going to be pouring it right back into your communities. And if they're hiring people, those people are going to be spending that money. So the money comes in and it just circles around. I mean, that's the beauty about this. And when you look
I can't agree more.
Well, yeah.
I can't agree more, Woody. One of the things that I've been talking about a lot the last few weeks while we've had This Week in Crowdfunding was the implications for small businesses and, just around local communities. I mean, you think about what crowdfunding at its core is, it's creating a community around the people that invest in you. And to think of how many small businesses went out of business over the last 5 or so years, even before, during, and after COVID. I mean, this is such a perfect way to get the people in the community involved and around the businesses that they love, when they're struggling or even if they're not struggling. So there's so many different implications for crowdfunding. And I think we're starting, a lot of this data here shows me that as well.
Yeah. I mean, and to the point right there, $6.6 billion is being pumped into local economies.
100%, yeah.
But just to jump back for a second too, the success rate of these offerings is unrealistically high. And by that, I mean the targets that these companies set is unrealistically low. And the legislation requires that in order for you to receive any money that is committed to your offering, you must exceed your minimum funding target. So we've got these 80% success rate on average, I think, in November. But that's because, the median minimum funding target, I think, is about $40,000 or $50,000 right now. So it's not that hard to beat that threshold. But I think, without focusing on that, start focusing on the average raise. When the industry got started, it was like $100 and something thousand. It was small. So, we're 7.5 years into this. The average raise in November was $889,000. So it is dramatically increasing. And to that point that we talked about before, 43.7% of the deals in November were debt. And the average interest rate, 11.6% is what it was. It's been up 3 months in a row. So this is just another great opportunity for investors that are looking to, to earn some yield in the marketplace. And the last thing, that I want to focus on, now you can go to the next slide, is, valuations. So, when we started tracking this industry, we were just looking at valuations across the entire industry. And then we realized, you have to segment it. You have to look at pre-revenue versus post-revenue issuers. And you have to look at companies that are startup, which means that less than 3 years old, or established, which is over 3 years old. So this median valuation, what you're seeing right here, is across the entire industry. And it correlates with what you hear coming out of PitchBook or Crunchbase. in terms of what's happening in the venture capital marketplace, which is there might be a pullback in valuations from later stage companies, but at early stage companies, their valuations are still high. And so we're seeing that across, and this is just equity offerings, of course, but we're seeing that play out here in our data set as well, which the median valuation is at this very high level that we've seen over the past few years. But if you start to break it down by startup versus established, pre-revenue versus post-revenue, there's more logic that comes in. So your pre-revenue startups tend to have their lowest valuation because it's unproven, and your post-revenue established companies tend to have the highest median valuations because they're out there making money, done a round or two before, and this is another follow-on round. I'd like to see valuations come down. I thought they would. We haven't seen that play out. So this might be the normal that we'll see for the next year. I think the reason that they do stay this high, by the way, and this goes back to something that I mentioned at the very beginning of the conversation, is if you are an issuer watching this, are in control of your offering. So you're setting your valuation. So you can set a valuation which might be high, but if you've got a crowd of people that believe in what you can do, they might just invest in you at that valuation. So it's going to be different from a VC that's negotiating with you over a deal and negotiating over that valuation. Like, yeah, you know what, I like what you're doing, but I think your valuation is just too high. If we're going to invest, we're going to invest at, a lower valuation. And then you have to make that decision.
Yeah, I think valuation is a very complicated issue in crowdfunding, and probably the most complicated issue. And I think your guys' data does a great job of informing investors. But let me ask you this: is what can a crowdfunding investor do to make sure the valuation that they're investing in is a fair one? Because there's a level of due diligence that venture capitalists do that's very difficult for an everyday retail, even a more sophisticated call it retail investor to do. So what would your suggestions be to make sure that you're looking at a valuation that's fair?
I mean, I tell issuers all the time, I was just like, socialize your valuation with why you believe that's a fair valuation. Do your research, find out what comps are in the space. One of the services that we're launching soon is this offering insight report, which allows a company to enter information about, the revenues, the earnings, everything that you'd have on a Form C. It compares it to everything in the data set that we have, and it shows you the comps based on, other companies that have been successful at raising money and what their valuations are. That then gives you a data point that is based on fact, not based on, theory of where a range of what your valuation should be at. And so, I can't really tell investors, how to negotiate with, an issuer, particularly if the offering's already live, because I don't really think there's too much you can do. I think there's flexibility when it comes to these offerings that have, discounts in their valuation for early investors. So, if you're part of the first 200,000 to come in, you can get in at a lower valuation. I think, there's part of that plays out in the marketplace. I don't know how I really feel about that because, I feel that, in a way that could be gaming the system. I like to be, sort of pure in a lot of this. And, even with some of these offerings where you can't really tell, is the amount that's being committed right now part of this round, or was it from a prior crowdfunding round? I think there needs to be a little more clarity on the part of the platforms in some cases that lets investors know that this round's financing, or this is a cumulative amount of all the capital that they've raised. Yeah, it's important for you to know how much money they've raised since, in all of their rounds. Set your expectations on, okay, this is where they are in this round right now.
Woody, I got a question about the valuation. Do you think it's correlated at all with better quality of deal flow, higher quality of deal flow, and then also to the fact that we've seen more VCs partake in these crowdfunding rounds? Do you think that there's some sort of correlation because there's better startups, naturally their valuation should be a little bit higher, or maybe they have a better understanding of how to value their startup. With more VCs partaking, the VCs might have either talked to the startups beforehand and said, I think your valuation is between these set of numbers, or kind of said it beforehand with the founders. Is there any sort of correlation just because of how new this industry is? I feel like valuations will increase as long as they don't jump up like it was in ZERP in 2021 when everyone thought that they had $1 billion company and they were saying, oh, we're going to use AI, it's going to be $1 billion company. What do you think about that?
Yeah, I think you bring up a great point. The VCs that are syndicating deals on these platforms have already invested in them. Their valuations are going to be higher. That will drive up valuations over the time because they're by default, going to have more established companies with stronger teams, I believe. But I also think your point is well taken, that the dynamics of the industry changes the longer we're around, because more awareness increases that this is a viable way to access capital. So companies are going to be looking at, and a lot of the calls that we get even are from issuers going, tell me about this crowdfunding thing. Is it right for me? And, we have a whole conversation, and I'm been very impressed with the revenues of these companies that are looking at the space. One of the deals that we just looked at today, a company has $22 million in revenue. Like a $22 million revenue company looking at crowdfunding to raise, capital. I mean, that's a story in itself. But I think
where can I invest?
You got to look at the deal. But it makes sense to what you're saying, that as the industry changes and evolves, valuations will go up. I think part of what we need to do as an industry as well is push the SEC, push Congress to say we've proven that there's been relatively no fraud. There's been one instance of fraud in this industry. It's pretty guardrail strong for investors as well. So let's increase it from 5 million up to 20 million, and really open the door to some more established companies that could benefit from this community of investors that can help them get to the next stage of their growth. And I think that's the next evolution that we need to get to, other than, Brendan, to your point, how do we create the media awareness that we need to get the more eyes on this?
I just wanted to quickly go back to the benchmarking thing. I worked on Wall Street for 11 years. If you look at equity research and you look at stuff, the first thing you look at, okay, I did a lot of IPOs and SPOs. It's like the comps, right? What's the benchmark? What is this industry trading at on the different metrics? Where is this company at, and how divergent is it, right? So how much of an outlier? So that's why I think having the data like we provide, being able to benchmark, that's where Connor, that answer comes from, right? It's like, okay, if my whole industry is around here, but I'm looking for so much more, yes, then you need to have a serious explanation, and it may be a very good explanation on why you want that to be there. But that on average, the whole industry over the last 7 years has been trending around these metrics. I think that's some of the most valuable information pieces that you can have in terms of valuation, and seeing where the market is and where you are versus the market, and then position yourself accordingly. Now, whether that's causation or correlation, that's a whole different story. But I think it's a good point to make here.
Yeah, and the longer the industry is going to be around, the more data, which means more comps that we can have.
Yep.
And then we can have a better understanding of valuations and how the issuers should value their startups and how the investors should value the startups.
Yep.
Exactly.
It's a great point.
I mean, I don't know if you have other questions and all that stuff, but a lot of what we do is in these reports that we publish now. So we've got a weekly tear sheet that anyone can get for free. We've got a bi-weekly report, a monthly report, and of course our annual report. So
yeah, and as Woody also indicated, we're working on this benchmarking product, so look for something to come out pretty soon on that as well. And then just in general, there were some data points I think today, and maybe Woody and Connor and Brenda, you can talk to it as well, but which I thought was interesting and sort of timely. First of all, we have Congressman Patrick McHenry, who's not going for re-election. He was kind of critical in the conversations back in 2012 in the whole industry, and Woody, you may talk to that a little bit on your conversations with him. So how does that impact the industry, or not at all? But I think that's an important thing. And the other thing, which again is happening today as well, is the listing of the Republic note on INX, which obviously brings a completely new sort of world in private equity through tokenization. And I know Connor and Brendan, I've seen you talking about tokenization on some other of your podcasts. It's a whole different world, but I think you see that there are things happening that are all around this space. And yeah, Woody, I don't know if you want to say a few words specifically regarding Congressman McHenry here.
Yeah.
Before you go, Woody, I just want to let anybody that's watching on YouTube, if you have any questions, to put it in the chat, and I'll moderate it, and I'll send them over to Woody and Yvan. So, Woody, go ahead. I just want to make sure I mention that.
Yeah. Congressman McHenry, there were many people that were necessary in order for this idea to become a law, and Congressman McHenry was one of them. He was a champion for what we were doing. He took our idea and turned it into a bill, which was required. He was chair of the Financial Services Committee, which helped usher it to a vote in the committee and get it to the floor of the House. That just doesn't, there's thousands of bills that are ideas that just never make it to the floor. So to have his support and have him understand the potential that was in this was critical. He has been a voice and an ear for this industry since it got started. He's been a champion for moving the caps and limits, trying to reduce barriers and friction that exist in the regulation itself. So I think it's a loss for the industry that we won't have him there where we can, share with him, what we need. But I want to reflect that, this couldn't have happened without him. And it is a big loss to the industry. And I do wish him well. I think that's, a big loss. But the Republic Note, I think, is another innovation that's taking place in the industry, which is how do we take everything that's going on here and diversify in this space without having to make a single investment and try and pick a winner. It's a fascinating take on, take the earnings, take the valuation. I don't know if if Republic has warrants on their investments, but but it's they're taking how these, all these companies and what they have, and they're turning it into, this token now that investors can buy in for the potential of these companies having their exits and getting the liquidity returned to them that way. Or, I just think it's another fascinating take on where the industry's evolving.
I was talking to one investor and I was asking him questions about, startups he's investing in. And he said he was investing in a lot of individual startups, but recently he's been really big on just investing in the start engine, Reg CF they just had. I think it was a Reg CF, maybe it was a Reg A.
It was a Reg A.
Reg A. So he said, I liked doing that, but then I started thinking, why don't I just bet on the house? Because Start Engine, I think this industry is going to be very massive in the next 10 years. Start Engine is one of the leaders. Why don't I just bet on them? Because I don't have to pick a winner. If the industry is going to grow and get very big in the future, all I have to do is kind of pick Start Engine, because as the industry grows, they will continue to grow and my investment should grow. I was like, I kind of like that approach. And it seems like a lot of these platforms are starting to, whether it's the Republic Note, figuring out how to tokenize and then create an investment so you can more or less invest in the industry growing in the future and the company growing based off the industry growing. I think that's a very unique approach and I'm excited for it.
Sort of an ETF, right?
Yes.
Yeah,
exactly.
I mean, that's kind of what I've taken from the Republic Note. Like, me and Connor have publicly last week and then privately been talking about it, and we were texting each other. We were like, I get what they're doing, but do I really get it? Like, do I get how I would do better? And and I guess the way that I've kind of tried to explain it to myself is if you're investing in Republic Note, you're kind of becoming an LP of an LP in a venture fund.
Yeah.
Like you're not necessarily the LP, right? But
No.
you're an LP of that LP. It's definitely more layered and more complex than just if Republic does well, the Republic Note's gonna do well. It's definitely more complex than that. I'm very, very interested. I was just before we came on about an hour ago, I was looking on Twitter, and the coin shot up. I mean, every coin has their moment, right? It seems, but there seems to be demand, and if anything, and I said this last week to Connor, there seems to be a lot of crossover between the crypto industry and the crowdfunding industry, especially right now. Just the people that are interested in it, early adopters almost. And if we can get more of them involved, they seem to be open-minded to more of these alternative investments. Maybe more traction can come from it.
Well, maybe a little pitch again for some of the data that we have, but that in our monthly reports we have every month a special industry that's being highlighted. So the first one that's out right now is the life science industry. So the next one will be Woody, tell me, is it food or is it beverage?
Beverages.
It's beverages. I like FMB. So we're talking about beverages. But in December, we're going to have a special about blockchain/crypto/Bitcoin. Why? We have the capability of attaching flags on every single offering. And we've looked through the database. And again, correct me if I'm wrong, Woody, but I think we have about 219 companies in the database that are related to something in blockchain, crypto, or Bitcoin. So people are looking for exposure. Again, you can go to Bitcoin, but everybody's always looking for an indirect way also to get exposure. Right? What's sort of the secret way to get huge upside for somebody who's doing something interesting in the space?
Right.
Maybe it's one of these companies that is raising funds right now and maybe is at a ridiculous valuation. And if you do your homework, you may have a winner there. So I thought that's very interesting. So I'm looking forward to that special in December as well.
No, that's fantastic. And, we haven't gotten any questions yet. The people popping in and out. So I think we'll wind it down for today. I want to thank you guys for coming on. I really enjoyed it. I could talk about all these crowdfunding, the industry trends, whatever. There's so many different things going on. And I think that's why it's such an exciting time in Reg CF and equity crowdfunding. So I look forward to talking to you guys again next month. For all of you out there that are listening, they will be coming on the first Wednesday of January and the first Wednesday of February, and releasing their report as well. So we'll have another super in-depth, really intriguing conversation. So Woody, Yvan, thank you guys for taking the time. I enjoyed it. I know Connor enjoyed it.
It was awesome. Thank you.
Thanks for coming on.
Thanks, guys. Looking forward to seeing you.
Same here, guys. Thank you so much. Have a good
Alrighty.
night.
And for all the listeners out there, we will see you next time on Next Big Thing HQ. New episode coming out Monday at 9 a.m.